Hello, listeners. My name is Greg Leonberger. I'm the Director of Research here at Marquette, and the title of my flash talk is Pick Your Portfolio Poison, Recession or Inflation. Now, admittedly, this is a bit of a dark topic, but what we wanted to do is address two of the primary macroeconomic risks that our portfolios face and what to do in light of them. With this talk, we will cover the following agenda. We'll start by defining what recessions and inflation are. Next, we'll talk about frequency and causes of each. And critically, as the investment consultant, it is our duty to tell you about the portfolio impact for each one of these macroeconomic headwinds. We will then examine the current outlook for each one, and then depending upon which one we determine is more likely, talk about appropriate portfolio guidance. And by portfolio guidance, we mean things to do, perhaps more importantly, things not to do in the light of oncoming recession or inflation. Let's start by defining each term. A recession is defined as negative economic growth for 2 consecutive quarters. In other words, GDP contraction for 2 quarters in a row. Now, inflation is a little bit more difficult to define explicitly. For purposes of this talk, we're going to define inflation as rampant inflation, meaning inflation of 10% or more. Let's start by looking at recessions and how often they occur over the course of economic cycles. This graph here shows the occurrence of recessions as shown by the tan bars. There are 11 such occurrences for data going back to 1948. Then we also show GDP growth or economic growth shown by the blue line. Critically, the majority of readings for GDP growth are positive. That's not surprising. We are in an expanding economy over the long term here in the United States. A question we get a lot from clients right now simply is, are we due for a recession? We have been in an expansionary period for more than 10 years now, and some seem to think that just because we haven't had a recession in a long time, we are due for one. However, that is not the case. Recessions are driven by specific circumstances, and those circumstances vary over time. I think we can all explain what caused the last recession in 2008. We had the housing crisis, we had the credit crisis, also known as the Great Recession. Prior to that, we had the dot-com bubble bursting, as well as the September 11th terrorist attacks. That led us into a recession. The 2 recessions prior to that I would call oil shocks. We had the Gulf War, and we had the Iran energy crisis. Those impacted energy prices and pushed us into a recession. As I mentioned at the outset of my comments today, inflation, what we're defining as inflation, rampant inflation, 10% or more, is less common. We only have 4 such readings of inflation greater than 10% going back to 1948. Now, similar to recession, inflations each have their unique drivers. The most recent set of high inflation, which we saw in the late 70s and early 80s, was really driven by high gas prices, what we call kind of the oil shock. Prior to that, inflation was driven by the decoupling of the dollar from gold. The decoupling of the value of the dollar relative to gold caused massive devaluation of the currency of the dollar and pushed prices up radically. Prior to that, coming out of World War II, there are 2 ways to pay our bills from World War II. We can either increase taxes or increase the money supply. Increasing taxes coming out of a war is never a particularly attractive opportunity for anyone. So the choice was to increase the money supply, which pushed prices up quickly and pushed us into a high inflationary period. So that's the background. We've looked at frequency, we've looked at causes, we've defined recession and high inflation. What does this mean for portfolios? We're going to start with recessions. So what we're showing here are simply bonds, stocks, and then inflation. Inflation will be important because once we get to the inflation part of economic headwinds, the inflation component can really dilute returns. So that's why we're going to show it for each instance. So recessions, probably not surprising. We're going to show bonds by the blue bars here. We're going to show equities with the green bars, and then inflation will be with the purple. Not surprising, recessions tend to feature low rates in an effort to spur economic growth. There's less consumer spending, there's less spending on behalf of businesses. Bonds outperform during recessions. Now, what about those periods of high inflation? Now, admittedly, this is a little bit of a difficult analysis because high inflationary periods have been pretty rare. Particularly going back to 1948, there's not a whole heck of a lot of economic data to investigate asset class performance. So unfortunately, we only have 2 such instances to examine, but we're going to make do with what we have. Again, we show bonds in the blue, stocks in the green, and inflation in the purple. Now, inflation is really important here because during periods of high inflationary periods or high inflationary environments, we talk about this idea of real return, which is nominal return minus the rate of inflation. If the purple bar is higher than both stocks and bonds, rest assured that investors lost on a real basis. Once adjusting for inflation, they lost money. Certainly for that first period from 1974 to 1975, investors lost money. The second period, from 1978 to 1981, stocks did slightly outperform inflation, but again, just done on a real basis, it wasn't much of a profit for investors. So at this point, we've determined that bonds do better in recessions. High inflationary periods is less clear. Now, what about for portfolios? Because the question here that I posed at the beginning is we want to pick our portfolio poison, recession or inflation. And we're going to look at things here on a portfolio level as opposed to an asset class level. We're going to have a simple 60-40 portfolio shown by the blue bars. Then we're factoring inflation, shown by the purple, and the real return, nominal returns minus the rate of inflation, shown by the light blue. There are a lot of bars here of varying length and magnitudes. Kind of hard to compute averages in your head, so we've done it for you. The average returns for each one of these instances is shown in the light orange dotted line. The conclusion is that recessions are less damaging, and critically, that's the phrase, less damaging to institutional portfolios than high inflation, as shown by the dotted orange line under the recessionary periods. It's closer to zero than the dotted orange line for periods of high inflation. So, where are we today? Of these two macroeconomic headwinds, the risks to portfolios, which is more likely? The New York Fed has a tool which determines the probability of a recession by comparing the yield on the 3-month Treasury and the yield on the 10-year Treasury. Note the two tan bars there, highlighted by the elevated spikes in the blue line. Those were the last two recessions we had. This tool appears to be fairly accurate in terms of predicting future recessions. It doesn't get the timing exactly right, but when you see these large spikes in this indicator, it tends to suggest that a recession is on the horizon. What's less clear is that lag between the spike in the indicator and the actual onset of the recession. How about inflation? We're going to look at the suggestion of inflation really using just two data series. The green line shows the market expectation of what inflation will be. Again, this is the market expectation as suggested by various models. And then the orange line is actually the actual inflation. So the difference between the orange and green line, if you look at the difference particularly directionally, that can help you suggest where inflation is going, help you indicate where inflation is going. In this case, the green line is below the orange line. That means that expectation for future inflation is that it's going to be lower, that it is falling. So this leaves us kind of with an elevated probability of a recession and the expectation that inflation is actually going to fall further. From that, we conclude that we think recession is more likely. So what do we do? What should investors do in order to prepare their portfolios for a recessionary period? And again, I pose the question, and I think this is actually the more important question, what should investors avoid doing in light of a potential recession around the corner? The first question we have to ask is, can we perfectly predict when a recession begins and ends? If that's the case, then there's some guidance we can develop, some advice we can offer to clients. However, if we cannot perfectly predict that, if we have to account for the imperfect timing and not knowing exactly when a recession begins or ends, the guidance tends to change a little bit. Now, the last bullet here is worthy of consideration, and quite honestly, this last bullet was originally thought to be the majority of my comments in this talk today. However, the findings of that have been less conclusive, and we'll circle back to that in just a couple of minutes. First, though, I want to start with the fact that equities can still move higher. I've tried to make this point on an earlier slide when we talked about that tool in the New York Fed and that squiggly blue line. If a recession is coming the first time yield curve inverts, and we saw yield curve inversion in August, we still don't know exactly when that recession is going to begin. What this chart highlights for all of you is that, number one, the period between first sign of yield curve inversion, the onset of a recession, can vary anywhere from 10 to 23 months. That's a lot of variation in quite a bit of time, particularly as measured by the financial markets. Now, connected to that, before the onset of a recession, stock markets tend to run higher before perhaps correcting. Again, using these same data points, you saw a cumulative return anywhere from 8.5% to almost 41%. Moving too quickly out of equities, abandoning a long-term investment policy statement, simply out of fears that a recession is coming at some point in the road, can cost investors quite a bit of money. Now, let's get back to the idea of, are there certain asset classes that perform better during a recession? We've already made this point. We're going to look at it just in a slightly different way now. Now we're showing bonds in the green. We're going to show U.S. equities in the purple and non-U.S. equities in the blue. 4 out of the 5 instances here have shown that bonds outperform. We've already determined that, nothing new here. But now we have to account for imperfect timing because we don't know when a recession will exactly begin. We don't know when a recession will exactly end. So if we move out of our long-term investment policy statement, which usually means moving away from equities towards bonds too early, it can cost investors. Again, bonds here in the green, equities in the purple for U.S., blue for the non-U.S. Look at that. 4 out of the 5 time periods, equities outperformed bonds in the year prior to a recession. Now the theme is going to look very similar to if you stayed too safe for too long. In other words, if you stayed in bonds too long during a recession, thought the recession was going to last longer than it actually did, here are your bonds in the green, here are equities in the purple and blue. Again, for 4 out of the 5 time periods, equities outperformed coming out of recession. Moving too early or staying safe too late can cost investors. Now let's circle back to this other point that I wanted to make. When we first set out on preparing this talk, one of the analysts on our teams probably spent the better part of 3 days looking at the trade-offs between these various asset class composites. Credit versus treasuries, short versus long duration, small cap versus large cap, value versus growth in US versus non-US. And once we factor into consideration that we cannot get the timing precisely right, so we have to account for periods before the recession, during the recession, and after the recession, there are no clear-cut themes here, which is really counterintuitive when you think about some of this. I think most of us would expect that treasuries outperform credit during recessionary periods. And perhaps during a recession that is true, but for the periods before and after, similar to the outperformance of equities, credit tends to outperform. So there are no clear themes here, given that we're not going to perfectly get the timing right around the beginning and end of a recession. So where does this leave us? Well, to circle back to a couple themes we've already made. Recessions tend to happen more frequently. And perhaps, in a little bit of a relief to investors, they are less damaging to portfolios. If we can time it right, being more defensive, being more in bonds during a recession tends to protect portfolio principal just a little bit more. But at the end of the day, we can't get the timing right. So we really encourage our clients to stay disciplined, not overreact, and maintain those long-term investment policy statements and focus on the long term. So that's the conclusion of my remarks. I thank you for your time.